Now we're going to walk through compensated absences. In this example, it's going to be fairly simple. We're not going to make it too complicated. But I do want to walk you through the journal entry just to give you a better understanding of how compensated absences work. First of all, for compensated absences, they must be accrued as they earned if they meet 4 criteria. First of all, the absence, the employer's obligation must be the result of employee services that have already been rendered. So this would be vacation days based on work that an employee has already done. Second of all, the rights to these compensated absence, the right must vest or accumulate, so it can't be constantly use or lose or something like that. The payment of the compensation must be probable, and the amount of compensation can be reasonably estimated. If all 4 of those criteria are met, then the employer must accrue an additional liability for compensated absences. Sick days are the only thing in this section that can be a bit tricky, because if the employee can only take a sick day due to illness, then the idea of probable compensation becomes a question. But if they can take it for any reason, then the probability is pretty high, and so then they must accrue it. All right, so we have an employee earning $15 per hour. For every 40 hours that the employee works, she earns 2 hours of paid vacation. Then the scenario is they work 160 hours in January and then 152 in February, along with 8 vacation days. Or I'm sorry, 8 hours of paid vacation. All right, so let's talk about January. So in January, the payment would have been, 15 hours times 160 hours, $15 per hour times 160 hours, or $2,400. But they also, the employee would have earned some vacation days, and so we have to accrue that at $15 per hour times the 8 hours of paid vacation that they earn. Again, in total, that for every 40 hours of work, they earn 2 vacation hours, and so in this case, they've earned 8 hours in the month of January. And so the journal entry, pretty straightforward. We have the cash payment along with the wage payable, and from that we infer the wage expense in January as the addition of the 2. So the first one's not too bad. The second one's not too bad either, but maybe a little more complicated. And so in February, the same cash payment. They're paid for the 152 hours that they work, plus the 8 hours of paid vacation that they use. So they're still paid for 160 hours of work, essentially for $2,400. Where it's a little different is with the compensated absence. And so because they still worked 152 hours, they would have earned an additional 6 hours of paid vacation, but they used 8 hours of paid vacation. So in total, the wage payable that had previously been accrued related to this compensated absence would have gone down 2 hours. And so that decrease of 2 hours multiplied by their hourly wage of $15 per hour means there needs to be a $30 net decrease to the wage payable account. And so that journal entry, sort of coupling it with the one prior, you can see the cash payment is the same between the 2 months. But now, because the wage payable is decreasing by $30, the inferred wage expense is different than it was in January. And again, because in January we were accruing wage payable, but in February they are partially using up that paid vacation. And so you get a different wage expense every single month, even though the cash payment is constant.